Stock market ratios are essential tools used by investors and analysts to evaluate the financial health, performance, and valuation of companies. These ratios provide insights into a company's profitability, efficiency, liquidity, and solvency, helping investors make informed decisions. Understanding the various types of stock market ratios is crucial for anyone involved in equity analysis, as they offer a comprehensive view of a company's financial standing. This exploration delves into the different categories of stock market ratios, explaining their significance, how they are calculated, and their applications in investment analysis. 1. Valuation ratios. Valuation ratios are used to determine the market value of a company relative to its financial performance. These ratios help investors assess whether a stock is overvalued, undervalued, or fairly valued compared to its peers or historical averages. Price to earnings, P/E ratio. The P/E ratio compares a company's current share price to its earnings per share, EPS. It indicates how much investors are willing to pay for each dollar of earnings. A high P/E ratio may suggest that a stock is overvalued, while a low P/E ratio could indicate undervaluation. However, the P/E ratio should be considered in the context of industry norms and growth prospects. Price to book, PB ratio. The PB ratio compares a company's market value to its book value, calculated as total assets minus liabilities. A PB ratio below 1 may indicate that a stock is undervalued, as the market value is less than the company's net asset value. Conversely, a PB ratio above 1 suggests that the market values the company more than its book value, potentially due to strong growth prospects or intangible assets. Price to sales, PS, ratio. The PS ratio compares a company's market capitalization to its total sales or revenue. It is particularly useful for evaluating companies with little or no earnings, such as startups or companies in cyclical downturns. A low PS ratio may indicate undervaluation, while a high PS ratio could suggest overvaluation. Enterprise value to EBITDA, EV/EBITDA ratio. This ratio compares a company's enterprise value, market capitalization plus debt minus cash, to its earnings before interest, taxes, depreciation, and amortization, EBITDA. It provides a more comprehensive view of a company's valuation by considering debt and cash levels. A low EV/EBITDA ratio may indicate undervaluation, while a high ratio could suggest overvaluation. 2. Profitability ratios. Profitability ratios assess a company's ability to generate profits relative to its revenue, assets, or equity. These ratios provide insights into a company's operational efficiency and financial performance. Gross profit margin. This ratio measures the percentage of revenue remaining after deducting the cost of goods sold, COGS. A high gross profit margin indicates efficient production and pricing strategies, allowing the company to retain more revenue as profit. Operating profit margin. The operating profit margin measures the percentage of revenue remaining after deducting operating expenses, including COGS, wages, and overhead. It reflects a company's ability to manage its operating costs and generate profits from core operations. Net profit margin. The net profit margin measures the percentage of revenue remaining after all expenses, including taxes and interest, have been deducted. It provides a comprehensive view of a company's profitability and financial health. Return on assets, ROA. ROA measures a company's ability to generate profits from its assets. It is calculated by dividing net income by total assets. A high ROA indicates efficient use of assets to generate profits. Return on equity, ROE. ROE measures a company's ability to generate profits from shareholders' equity. It is calculated by dividing net income by total equity. A high ROE indicates effective use of equity to generate returns for shareholders. 3. Liquidity ratios. Liquidity ratios assess a company's ability to meet its short-term obligations and manage its working capital. These ratios provide insights into a company's financial flexibility and ability to withstand financial stress. Current ratio. The current ratio compares a company's current assets to its current liabilities. It measures the company's ability to cover short-term obligations with its liquid assets. A current ratio above 1 indicates that a company has more current assets than liabilities, suggesting good liquidity. Quick ratio, acid test ratio. The quick ratio is a more stringent measure of liquidity, excluding inventory from current assets. It compares cash, marketable securities, and accounts receivable to current liabilities. A quick ratio above 1 suggests that a company can meet its short-term obligations without relying on inventory sales. Cash ratio. The cash ratio measures a company's ability to cover its current liabilities with cash and cash equivalents. It provides the most conservative view of liquidity as it only considers the most liquid assets. 4. Efficiency ratios. Efficiency ratios assess how effectively a company uses its assets and manages its operations to generate revenue and profits. These ratios provide insights into a company's operational efficiency and management effectiveness. Asset turnover ratio. The asset turnover ratio measures a company's ability to generate sales from its assets. It is calculated by dividing total sales by total assets. A high asset turnover ratio indicates efficient use of assets to generate revenue. Inventory turnover ratio. The inventory turnover ratio measures how quickly a company sells and replaces its inventory. It is calculated by dividing COGS by average inventory. A high inventory turnover ratio indicates efficient inventory management and strong sales. Receivables turnover ratio. The receivables turnover ratio measures how quickly a company collects payments from customers. It is calculated by dividing net credit sales by average accounts receivable. A high receivables turnover ratio indicates efficient credit management and strong cash flow. 5. Solvency ratios. Solvency ratios assess a company's ability to meet its long-term obligations and financial stability. These ratios provide insights into a company's capital structure and risk of financial distress. Debt-to-equity ratio. The debt-to-equity ratio compares a company's total debt to its shareholders' equity. It measures the proportion of debt used to finance the company's assets. A high debt-to-equity ratio indicates higher financial leverage and risk, while a low ratio suggests a more conservative capital structure. Interest coverage ratio. The interest coverage ratio measures a company's ability to cover its interest expenses with its operating income. It is calculated by dividing EBIT by interest expenses. A high interest coverage ratio indicates strong financial health and the ability to meet interest obligations. Equity ratio. The equity ratio measures the proportion of a company's assets financed by shareholders' equity. It is calculated by dividing total equity by total assets. A high equity ratio indicates a strong capital base and lower financial risk. 6. Market performance ratios. Market performance ratios assess a company's stock performance and investor returns. These ratios provide insights into a company's market perception and attractiveness.